the days of us sustaining, keeping inflation in a target range while getting what we want to out of the employment side of the economy, I think those days are over.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And I'm joined as always by the brain trust himself, Mr. Chase Taylor. So back at it, put your white away. Can't wear white after Labor Day, right? And
funny story, you gave me a white shirt today.
Oh, yeah. Well, white pants. It's only white pants. I believe that rule only applies to pants.
I think I learned that in like Fried Green Tomatoes or whatever old movie that was.
Yeah, it's a Southern deal. See, here's the deal, though. I don't think that applies in this part of the world. You know what I mean? And it's because the seasonality isn't enough. You know what I mean? For instance, around here, you might encourage people to wear white in the dead of winter, just like it's like hope. Like around January, February, you start feeling like a vampire around here.
It's kind of true. I'm here for it though.
Yeah. Well, this is why I always try to plan a vacation for February.
Yeah,
January
makes sense.
You got to get that vitamin T, hitting your body, hitting your skin, making you feel alive. No, but interesting, just because it cracked me up. We were just talking last week about how the seasonality of September and October bothered us, especially how the market just drifted higher. One day, first trading day of September, you can't really take too much into it, but it did amuse me today to kind of see the market down. I mean, we can get into the indexes. I think they all finished right around, 0.7, 70 bips down, something like that. But at one point you had the S&P down 1.2, 1.3 and kind of seemingly on no news, except just the first day of September. Again, I think it's way too early to say that that's what we're seeing, but that's kind of what seasonality looks like. All of a sudden you just flip the calendar and you're just like, why is everybody selling stocks? So that kind of concerns me about the next month and a half to 2 months, especially when you add that to kind of what I'm referring to. And I just had this conversation with a client, kind of the NVIDIA, what I'm calling the NVIDIA issue, where it's nothing bad. I'm not freaked out about, things plummeting. It just, and look, 3 weeks from now, we could be completely wrong, but it does very much feel like that. I think there's a lot of stocks out there that are going to have a very hard time living up to their price over the next 1 to 2 months, would be my feeling on that.
I tend to agree. Like everyone's freaking out about tech and I'm like, sure. But that 1 to 2 months feels like we've had these little miniature AI cycles where we go from everyone loves it, hit the button so people can see my beautiful face, by the way.
Oh yeah.
And
I thought I had that.
We have these mini cycles where it's like, AI is the best thing. If you don't own it, you're gonna die. And then
you're stupid.
And then you get like 3 months down the road, and AI stuff is like really driving the bus. And then there's like one little piece of bad news, and it's like AI is the biggest bubble in the history of the world. If you own it, you're an idiot. And then you have to go down for like 6 weeks or 2 months or whatever. And then there's gonna be some headline that's like, oh my gosh, AI is gonna take over the world. We'll probably go through this again. So I think you probably nailed it with that month or two thing.
Yeah, and I'm not even really opposed to the AI cycle. Like, I think it's a huge deal. I think it's unbelievable. It's, just all the superlatives. I just don't think AI cares nearly as much about home country bias as the rest of the market seems to. So, our whole take has been like, hey guys, I agree with you. There's an AI revolution. And to think that US stocks are the only one that are going to take advantage of it.
Exactly.
And then look at relative valuation and all the stuff that we know about. Like I'll continue to see that. I think the tech bros shockingly are missing one of the biggest opportunities out there right now, which is Asian and Chinese based tech that has not gotten an AI premium built into it at all.
Despite having the AI performance there.
Right. And that's where I just continue to think that one of the greatest dangers out there is going to be sitting on underperforming US equities in an inflationary environment and thinking, oh, we're still going up, but then doing an adjusted for inflation calculation 3 to 5 years down the road and realizing, holy smokes, we have not done well as it relates to inflation. And look at these other countries out there that have absolutely blown us away. And, again, nobody knows the path forward at any given time when it comes to markets and everything. I will just continue to say, if you don't have some kind of awakening or come to Jesus moment like that over the next 3 to 5 years, on a relative basis type scenario, I'll just be shocked. I do not understand how, in a world of publicly traded assets, with the world taking the look on, and it does, the table looks substantially different than it did between 2009 and 2020. It looks so different, right? Where all of a sudden the U.S. and China were kind of the only countries in a place to really do something. They were the source of real growth. You're looking around the globe, you're seeing green shoots for growth. You're seeing, different policies being pursued by so many of these different governments and countries around the world. It just, for lack of a better term, and I think you keep seeing it. One of the things we were talking about in our investment meeting call this morning is something I keep trying to keep in mind. And I can often be the greatest detractor for our own portfolio and our own positions, just because when you own them, you tend to be a little bit familiarity breeds contempt. And I have to keep reminding myself, even as it relates to the price of gold and so many of our gold miners, we're like, oh man, this feels like it's getting a little overcooked. And then you got to step back and remember what's taken place over the last 15 years. And to look around the world today, and we were talking about this on our call again, to remind myself that when I look around the world today, $3,500 gold is probably not the thing that should scare me. I think $3,500 gold makes a lot of sense. I think silver breaking above 40 makes a lot of sense. And I think that might be, and I think it's probably going to be, one of the biggest challenges investors face going forward, which to some degree is what we've faced up until now, which is sticking with positions that seem like they've run too much and making sure that you're always keeping it contextually matched up with what's really going on out there in the world today. Because, when you just think about the increase of money supply, debt, deficits, all that kind of stuff, and then you flip back and look at $3,500 gold, it's not really that shocking, especially when you look at all the internal dynamics, lack of new mine openings over the last decade, all that kind of stuff. $3,500 gold starts looking a lot more sober.
And what's interesting to me, and that I almost mentioned this morning in our meeting, but just forgot. But by the time I was going to get to it, but if you go back to before Friday, before the Jackson Hole meeting, gold looked like it might actually want to break down. And then when he came out and basically said we're just going to probably look through that tariff inflation, gold was like, oh, you're going to what? And we've just gone straight up since.
Well, and that's one of the things that concerns me. Because if you think about it, and it concerns me in a good way, because when you think about it, to me, the moment for gold, and we maybe have already had it, was when the market figured out or ascertained from policymakers that inflation was the only way out. And I'm not saying that's what Powell said.
Right. Not at all. But
what I am saying, though, is that is a statement moving down that road. You know what I'm saying? That's a way station on the path to admitting that inflation is the only way out. And watching the way gold responded to that, kind of, at least in my mind, backed up that take. And I think that's what you're seeing going on. I think that we are in the process of both markets and policymakers coming to the conclusion that the days of us sustaining, keeping inflation in a target range while getting what we want to out of the employment side of the economy, I think those days are over.
Yeah, you just feel like this tension coming where eventually you just kind of have to pick one of those mandates. You don't get to have both.
Yep.
And we're now at the moment, it's to be fair, it is mostly, I think, because of tariffs, but regardless, we have tariffs. So, well, for now, they do have to make that decision at least in the next year or two. So, and eventually you get to a point just via fiscal and stuff where you even without tariffs, you'll have to make that decision. We just kind of brought it forward with the tariff inflation, I think.
Yep. And it seems like a pretty clear story at this point. You know what I mean? inflation seems to be really the only way forward. And like I said, I just don't, and I don't think it should become to a surprise. I mean, meaning if your policy is that recessions and slightly higher unemployment are no longer politically expedient or acceptable,
right?
Then you're going to have to live with a higher level of inflation.
Clearly there. I mean, we have 4.2% unemployment, and people are, can't wait to cut. So like, we would have killed for 4.2% unemployment for most of history.
Oh,
the 20-year average is 4.9. I mean,
well, I mean, and then go look at, I mean, what is the 50-year average for the 10-year? Probably right around the same.
Yeah.
Right. I mean,
speaking of, should we hit the market? So
yeah.
About rates.
Yep.
S&P closed down 0.69, Q's down 0.84, IWM down 0.54, equal weight was down 0.79, Mag 7 down a little over 1%. All world ex-US was also down 0.69, so same as S&P, but that's notable given the dollar was up 0.64. So for the rest of the world to kind of stay with the US, given the dollar rip, that was notable to me. Bitcoin getting off the schneid here up to like 111K, up almost 2% on the day. Oil, solid rally up 2.5%, mostly because of dusting off the cyclical talk of sanctioning Russian oil stuff that kind of comes and goes every week or two.
Kind of interesting moves in gold and Bitcoin considering the dollar.
And then 100%. And then gold up 2.3, same thing for silver. Even platinum and palladium on the day. Platinum over 3, palladium up 4.5, copper up 1. You're just kind of getting like just real assets kind of unpinning here, while pure financial assets, equities, are doing the opposite. The 2-year was up about 3 basis points, and the 10-year and the 30-year were up 4 basis points. So, and if you look on the chart, it's starting to look like it wants to like actually break higher on long-term yields. And a bit of a global story today with French and UK yields ripping higher. UK yields are at 30 years at a highest since 1998, and French yields are highest since 2011. So anyone that's spending like a drunken sailor is getting punished by their bond market is the moral of the story. And speaking of, if you go by just primary budget deficit, we're number 1, and then UK and France are like right behind us. Well, not right behind us. We have a pretty nice lead there, but and vol closed the day up about 3%. And we finished well off, the lows like you mentioned. And it's worth noting that gamma flip level where you go from positive neutral gamma into negative. We were below that for a good chunk of the day, and then whoop, you just kind of the beach ball kind of found its way to the surface by the end of the day, which is notable. But it's obviously notable that if you end up back below that flip and you get into negative gamma as you head into jobs data at the end of the week, like that's where accidents can happen. So that'll be interesting to watch.
Yeah, definitely something to keep an eye on. Trying to think about any interesting news coming out.
So not news, but if you'll indulge me, I'll talk about offshore a little bit.
Oh yeah.
Because this is something that we were kind of looking at a little bit last week and finally pulled the trigger on a little bit this week. Not a big position by any stretch, and as always, not investment advice. That's about the most volatile stuff you can find.
No kidding.
So, but I was doing some research on this, and I was kind of blown away by some of the numbers. But so we're talking offshore oil rigs, companies that they own those things and they lease them out. That's the business model, and frankly, over history, a really bad business model. And like most things in this world, things start going well, and they buy a bunch of new equipment, and then things turn, and they have a bunch of equipment, and they're just staring at it, wondering what to do with it, and it's just burning a hole in their pocket. It's kind of like gold miners, where that capital discipline's always been lacking, or oil, like we've talked about before. But here in the last decade, we've seen oil companies like the producers, and we've seen a lot of precious metals producers kind of find capital discipline. And to me, that's one of the reasons I like offshore is they finally found capital discipline. If you go back to when oil was doing well, kind of that 2010 to 2014 range before that bubble blew up, these guys ordered 340 rigs from 2010 to 2014. Good. 340 new rigs. Since then, over the last decade, they've ordered 19. Not only that, but we're still getting a bunch from like that prior period delivered, which is crazy. But that's about to end. So if you actually go past next year, past 2026, there are no deliveries of any of these. and no one's ordering them. You've had one order in 2025, and that's for like one of the smaller, cheaper jackup rigs, not even like, you know, some big drill ship that cost $1 billion. And that's one of the reasons, like, they cost $1 billion. So you got to be sure you can rent that bad boy out if you're going to go spend $1 billion on something. And you know, these companies are worth $2-3 billion despite having $30 billion worth of rigs. Like, it's kind of wild to think of it that way. But that's where it's at. Like, so that supply and demand dynamic of, you know, what ruins these guys is when they buy too many and then the market shifts. Well, now they're not buying any, they're retiring a bunch, and the market is shifting. We know, like, the offshore capex for the producers is going up pretty significantly. We know these big offshore fields that are starting to get developed more in Africa and Guyana and Brazil. Like, you can see the inflection for the demand for their stuff. And then you look at the supply side and you're like, not only do they not want new ones, they're basically retiring old ones. Like, it just feels like a obvious, you know, setup to have a squeeze and how much they can charge for utilizing these things. And the utilization rate for the rigs is, you know, as high as it's been in a very long time. Like, they are using what they have, and a lot of the stuff they have stacked where they're not using it, it costs so much money to, like, put it back into service. They probably won't.
And maybe you haven't looked at this, but are there any good historical indicators for looking for inflection in day rates? Because I would think when day rates bottom, that's probably around the same time the stock does.
Yeah, and we saw that because, I mean, this is kind of too easy, but like 2020 washed them out. A bunch of them went bankrupt. A bunch of them retired some old stuff. They stopped ordering things. So, I mean, that was the bottom in day rates. You were like a good bit lower than you are here. So you've been up like 700,000-800,000. You got down to like 200,000. Now you're around 500. So you're well off the bottom. You're not at an all-time high for day rates. But my assumption would be, as long as people keep moving offshore and the demand for that's there, those, you know, we will put in those new highs in day rates in a year or two, maybe 3 or whatever. Plus, I mean, it kind of reminds me of uranium, where it's like, look, if you want people to go get the uranium out of the ground, like, the price has to be probably 200 to, like, really incentivize people to do it. Same here. Like, if you want these guys to like write a check for $1 billion to a shipyard to take delivery on one of these things in 5 years, you like, the day rate required for them to feel good enough to do that, to like let go of that capital discipline.
I think it'd have to be a lot higher.
It's not here, right? Yeah. I mean, you could get up to $1 million a day, in my opinion, in the next 5 years. And at that point, like, some of these have pretty clean balance sheets. So if you push them to, you know, day rates like that, the money they're making is substantial.
So it's kind of like, and we've, like you said, we've seen similar dynamics with this with the actual producers, but it sounds kind of like the whole idea of, hey, while they're not ordering anything new, let's buy them. And when they start ordering new rigs, then sell them.
Pure like capital cycle stuff. Where, you see them get too loose with CapEx, you let them go. And then, but you see them get tight fisted. And, you know, they've had to eat pain since 2014, really. They've had some decent rallies along the way, but for the most part, they've drifted lower for the last 11 years. But, you know, that a lot of them washed away all this debt, or a bunch of their debt, along the way, tightened up ops. Like, the technology's really helped with the way these things run, and just the breakthroughs in technology. Like, some of these things are incredible. Like, the drill ships, which are like the biggest, most expensive things, you're talking like a 700-foot vessel with a 200-foot oil derrick on it. Like, jeez, these things are monsters.
Yeah, that's a lot of
technology. Like, and they have like the thrusters that sometimes they won't even put an anchor. It's like thrusters that are programmed to figure out the wind, the tide, the waves, to keep the thing in place while it drills. Like, and it's just all automated. Like, some pretty cool technology.
You know, I've always wanted to go out to one of those drill rigs, because those drill rigs have been extraordinarily advanced for a lot longer than most people realize. And I don't think most people have an understanding of exactly what those things do.
100%.
They're incredible. The seas that they can handle, and it's pretty remarkable.
I mean, one of those, you can drill 40,000 feet. I mean, you can go through 12,000 feet of water and then another, 20, 30,000 feet of land.
Just another
to drill
6
for
miles
oil.
down.
Like it's
It's wild.
pretty crazy stuff.
Well, hey, I gotta exit stage left. I've got a call that I gotta hop on, but you can tie things up here for us.
All right.
Sure, you got.
I'll have to fly over there and grab the mouse after, but yeah.
I'm kind of throwing a curveball at you, but it is what it is. Anyway, all right, you guys have a good one. Chase, you can finish it up for us here, but and I even converted you back to the green, so we'll switch pilot seats here and.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
Hot swap.
Yeah.
And podcast history right there. So one other thing I guess I can talk about is the tariff situation, and something we talked about on our meeting today, and that is, we had a appeals court, I think it is, say like, oh, yep, no, those the tariffs are illegal, the IEEPA tariffs, but it's not over. They're going to kick it down to the international court that ruled that to like look at it again or something. Eventually, this ends up in the Supreme Court, and I have no idea which way they rule. I'm not even super confident on what I think on the legality part, honestly. And there's 5 different ways to do tariffs. That happens to be one. It was like the highest leverage way of doing it, where you could kind of single out countries and go after them versus singling out products, things like that. So it's not necessarily the only way to do tariffs as a trade policy, but it seems like probably the only way to really do tariffs as a foreign policy tool, a way to like try to get individual countries to do deals. So if it were to get tossed out, apparently they have to pay back the money, which is pretty wild. So you go from having, let's call it 300 billion in income, kind of on the government's balance sheet or income statement, to 300 billion of giving it back, right? And naturally, you would have to sell debt to make up that 300 billion, and that becomes a short-term liquidity problem, because all of a sudden the market has to sell, 30% of $1 trillion worth of government debt securities that it didn't think it had to do. So that would be a short-term headwind. Now we're about to do that with the TGA, 300 billion worth, in like 2 months or 3 months or whatever. So it's not like we can't do it. It's not catastrophic from the debt standpoint, but from an ongoing deficit standpoint, a lot of people are like, well, the big beautiful bill added X to the debt deficit, but it's kind of being, at least partially washed away by tariff income. So you can look at the combo of that bill and tariffs as close to net neutral. Now you can argue, in some years it's not at all net neutral, in some years it's more than net neutral, based on the way the law is written, because some of that stuff will never probably actually have the sunset provisions light up, of course. But regardless, yeah, there's no arguing that it did sterilize a nice chunk of the new deficits brought on by that bill. So if you undo that, then you don't get to say like, hey, maybe the deficit can go from 7 to 6 or 7 to 5%, thanks to tariff income. What you're going to be looking at is like, ooh, well, maybe now we're going from 7 to 8% deficits, which I would have to assume the bond market wouldn't appreciate, and maybe to some small degree, bond yields going a little higher on the long end since, Liberation Day, since the tariff ruling in the courts, so however you want to look at it. Maybe a small percentage of that is because of the fact that, the bond market has to start sort of pricing this, to think about like, man, well, if the deficit's going to be 8%, that is a lot different from 6. Like, that's less sustainable. That's more inflationary. And all of that requires, people to get a little bit more compensated for owning long-term debt, obviously. So the weird thing is, obviously, a higher deficit just on its own, is stimulative, and paying back all of these companies for the tariffs you charge them is very stimulative for their bottom line, right? Like corporate America wins big time on that, and then from an inflation standpoint, if all of a sudden, let's say automobiles are up 10% year over year, mostly because of tariffs. Well, all of a sudden those go away. Not only do they go away, but the people get, a rebate check for the tariff. Like now all of a sudden you're looking at it and like, oh, well, now auto prices come down. Like you start seeing huge sales on stuff, right? All that stuff would be great for economic activity and growth kind of on a short-term basis. So the question becomes, the exercise you have to kind of go through is which of those forces hits harder? The growth impulse from the tariffs getting pulled away and the, kind of rebate hitting and the lower prices. Is that more powerful, or is, bond yields kind of having to reprice at a new higher level? Is that not to mention, that growth impulse would help also push rates higher. So it's kind of sort of a double whammy. Like which one of those would win in the market? Would bond yields go into, say the 30-year goes to 5.5? Is that enough to cool off the tailwind that pushes earnings and everything, or no? And again, when it comes to that, I have no idea. But what I do know is if we do get this outcome, and to be clear, I don't think that outcome would be decided until Q4, if not more likely even probably Q1 of 2026, where the Supreme Court would look at this and decide. I think this would become a thing where like you'd probably see gambling odds and like Kalshi and Polymarket on how the Supreme Court decided on it. And people would have to start basically betting in actual financial markets based on what we all thought the Supreme Court was going to do. And if they put out some smoke signals along the way, the market would have to react to which way it looked like it was going to go. It would become a thing where you'd have to see in real time, like what the market seems to be doing with it to kind of get a better feel for what the market will do with it. I think obviously having less tariffs is really good for the economy, but an 8% deficit may be on some level so hot that it becomes a problem. Obviously, if the White House has fully captured the Fed, and I don't think that's likely personally into next year, but if they have, then they could just do QE, bring the long end down, and so you get the growth without any of the problems of pushing rates higher. And obviously that could weigh on the housing market. And speaking of the housing market, we don't really have details yet, but we got out over the weekend, Scott Besson talking about President Trump is going to essentially announce a national emergency on housing. Ostensibly, all we've seen so far is them talking about there being problem with houses being too expensive and there not being enough supply, that there's a shortage, which Zach and I have tackled multiple times on the show. You guys know my thoughts. There's not a housing shortage, full stop. There was a light inventory problem, for sale inventory problem for a while, for sure. But you're kind of back to pre-COVID normality on even that. And specifically on new homes, it's not just that, but it's bad. Like you have the most new homes for sale since 2007. You're close to the most in history. So inventories on new homes, how long they take to sell, all this stuff's already getting significantly worse. And to be clear, home prices have been negative nationally for 3 months in a row. And you're not too far from turning negative on a year-over-year basis. And that legitimately only happens in recessions and housing crisis. So that's not normal. It's not the normal state of affairs to have 3 months of negative prices in a row. And it's not at all negative. It's not at all normal to go negative on a year-over-year basis. But because I think, we went straight up during and after COVID, supply and demand was just completely out of whack, and supply and demand was out of whack, and people had a bunch of free money. So naturally, home prices went way higher. I think he went up 40% in like a 2-year stretch or whatever, like just monsters move up. I think it was always going to make sense for that market to kind of calm down, compress, even if it went sideways for 2 or 3 years, to let, the rest of inflation catch up to housing inflation, if you can think of it that way. It's sort of a digestion period. We go straight up. It would be good to go sideways for a while. If real incomes are trucking along up 2% a year or something, and housing prices are flat for 3 years, well, you made a 6% gain on that income to house price level. It's the kind of thing we need. So, to me, you should already be encouraged by the cooling of the housing market. Now, nobody wants it to go straight down, or honestly, you shouldn't probably want it to go down, as it would, that would start to mess with animal spirits. The current asset price driven growth we've talked about, where financial conditions lead the real economy. If house prices are going down, people look at those house prices, they look at their net worth, they start to worry that there's cracks in that. They spend less, that hurts the economy, and that feeds on itself. But I think you can deal with flat. I don't know if you should want down. Now, maybe the administration wants to instead find a way to get people to lower, have them subsidize lower rates, or find a way to subsidize, home equity lending at better rates than you can currently get. Something like that. I don't know. I guess we'll find out soon. But if this turns into a thing like where we, put a bunch of incentives out to build houses, like free money for builders, or subsidized, lumber or something like that, or targets on homes built and money tied, like whatever it is. Like if you too heavily incentivize building homes when you already have a glut, then I think you would turn into a situation where you could actually see not just negative home prices, but maybe significantly, especially in some regions where it's easy to build. Obviously in San Francisco, you can't just find land to go building on. It's one of the reasons it's expensive. But you get out in the Sun Belt, you can. So if you over incentivize it, and if Texas and Florida and stuff go out and build way more, and they already have too much inventory, you'll have some problems. So at the same time, I wouldn't expect builders to take the bait if they kind of pencil it out and realize what it would do. And builders aren't dumb, so I'm sure they would figure that out. Kind of like oil, like the administration wants a bunch of oil drilling, but the oil executive teams aren't going to go do a bunch at $60 or $65 oil. Like that's not how it's going to work. I would think it would be the same with homes. Like your margins are already compressed. Supply and demand has already really come back from that kind of post-COVID excess. So my assumption is that wouldn't work. But point is, I'm very eager to see what the details are behind this national emergency, which obviously it's not a national emergency, but it'd be interesting to see how that goes. Affordability, it's not great. Like it's holding an entire generation back from being able to buy a home, and that is bad. So something being done thoughtfully to help with that, would be good policy. But we'll just have to wait and see what policy does end up getting rolled out, assuming that something does. But that's all I have for today. We'll be back with more. The only data today was ISM, and it was roughly in line, so nothing to really talk about there. Bunch more labor market data as the rest of the week goes by, so stay tuned for that. But don't forget, you can download, subscribe, knowyourriskpodcast.com. And you can find Know Your Risk Podcast basically anywhere. Best place is YouTube, but pretty much anywhere you can find social media fun, you can find us. That's it for today. We'll be back with more tomorrow. Cheers.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.